Soft economic data sent the US yields and the US dollar down and the major US indices to fresh records before the July 4th holiday yesterday. Today, the US markets are closed, so we can fully focus on the British general election, where Labour is expected to achieve a landslide victory, ending 14 years of Tory rule. So, welcome. This is Swissquote's Daily Market Talk. So we are forcefully entering a period of bad news is good news as the Fed moves towards its first interest rate cut. Now, we don't know when the Fed will cut its interest rates. The Fed members themselves can't tell you today without more evidence of slowing economic growth and easing inflation numbers as printed by the latest Federal Reserve minutes released yesterday. But we know that the weaker the economic data, the closer the first interest rate cut from the Fed. So in this context, yesterday's soft data from the US fueled the Federal Reserve. The latest ADP reports show that the US economy added around 150,000 new private jobs in June. So that was less than expected by analysts and also slightly less than printed last month. Initial jobless claims rose. The factory orders unexpectedly fell in the month of May, and the ISM services unexpectedly contracted in the month of June. The employment component plunged while prices fell more than expected by analysts. As such, what investors saw in yesterday's data, the evidence that the Fed is looking for to cut its interest rates. So the US 2-year yield tipped a toe below the 4.70% mark, but bounced back to this level before the July 4th holiday. The US 10-year yield dropped to 4.35% level, while the US dollar index slipped below its June ascending channel base and tested the 50-day moving average to the downside. In equities, the S&P 500 and Nasdaq advanced to fresh record levels yesterday. So it was the 33rd record for the S&P 500 just this year, while Nasdaq 100 closed the session at 20,186 mark. What a day! Tesla jumped another 6% as momentum traders continued to join in, while Nvidia added more than 4.5% as well, and that regardless of the news that the company's CEO, Mr. Jensen Huang, unloaded $169 million worth of stock in June, so that was the most in a single month. Now, the US stock rally continues to be obviously shouldered by the technology sector and the big technology stocks. The others remain timidly upbeat. A lower interest rate environment in the US should help broaden the rally to other sectors, but other sectors could hardly print the same amplitude of gains than the technology stocks. So this means that if the technology tumbles, the rest of the market will suffer regardless. So the S&P 500 is seen posting an EPS growth of 9% in the second quarter. Then the EPS growth is expected to accelerate to double-digit territory later this year. The technology stocks are responsible for much of that EPS growth, but earnings outside the technology companies are also expected to overcome a profit downturn. So that's fundamentally good news, but it also means that an economic slowdown won't be a net positive for appetite in these sectors, where an economic slowdown could actually weigh on earnings. Because look, US crude eased yesterday after the soft US data, and energy stocks gained only 0.44% versus the technology's 1.35% advance during the session. But we will see. For now, appetite is there even in the middle of political jungle in the US and all of these rising uncertainties regarding whether Joe Biden will or will not be running for, November's presidential election. Now, speaking of election, Brits will be heading to the polls today, aiming to oust the Conservatives from power. Labour is walking into this general election with more than 20 points of advance over the Tories, which is huge because even the most conservative parts of the country now seem like they are tired of a 14-year Tory rule. The two most likely scenarios are a good Labour majority with 150 seats, which is almost double Boris Johnson's 80-seat majority in 2019, or a super majority with 250 seats. Both will give the Labour a very large margin to pass whatever reforms they want to pass in the coming years in the UK. Now, normally, I say normally, investors prefer conservatives as they have a better grip on spending and on the debt levels. But this time around, even investors want to see Labour take over the reins of the country. For Wall Street, a Labour win is positive for both the UK stocks and for sterling. Some big banks on Wall Street say that the small and medium-sized British stocks will benefit more from a Labour win than the FTSE 100 index, which is obviously mostly exposed to the global market dynamics and the global market environment thanks to its big exposure to oil and mining companies. Now, cable rallied to 127.72 level yesterday on broad-based US dollar weakness and its consolidated gains near the 127.40 level at the time I'm talking here this morning. Combined with soft dollar, we could see the end of the Tory rule in the UK support the British pound and back a move toward the 130 mark. Yet once the election vibes are over, eyes will turn to the Bank of England rate cut bets, and the latter could eventually limit the British pound's upside potential, but not the stocks. Now, on this side of the channel, the broad-based US dollar weakness of yesterday sent the euro dollar past the 107.50 resistance, and the pair shortly traded past the 108 level yesterday, but the French political risk prevailed and visibility is low into the second election weekend in France, where we just don't know whether Marine Le Pen will or she will not win a parliamentary majority. Here, while investors wish for a hung government in France that would prevent Le Pen's national rally from exploding the French debt levels, hence keep the borrowing costs and the yield spread with Germany at acceptable level for investors and avoid a Liz Truss-like market reaction. Yet a hung government in France is not an outright positive scenario, mind you, as it will prevent the French politicians from making any important decisions and moves for years without changing the fact that these latest elections in France have been a massive win for Marine Le Pen, whatever happens in the second tour. But a hung government will certainly trigger a relief rally both in the French stocks and in the euro next week, while a Le Pen victory, which is not the base case scenario, mind you, as per the market pricing and the market prices right now, would dampen the mood from Monday. Far from these jitters, the Japanese Nikkei is up for the third consecutive session and is approaching an all-time high level reached back in March this year. The dollar-yen doesn't dare to go above the 162 level for now. A broad-based US dollar weakness obviously helps keeping the pressure contained in the Japanese yen, as I think that the Japanese policymakers would be as happy as any investor or any mortgage holder out there to see the Fed move closer to the first interest rate cut. So today, US is closed for the July 4th holiday, so it's going to be a calm day. But tomorrow, tomorrow will be just another data important session for the world with the announcement of the June employment figures from the US. And that's going to be shaking the mood in the markets before the weekly closing bell. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.